Good morning.
Can you hear me?
Yes, sir. We can hear you.
Yeah. Thank you so much, Pastor Adeleye. My name again is Joshua Morawo. I'm an accountant and a member of CGA, CPA, and a partner at Morawo Financial Services. So today we want to look at Canadian personal income tax. What are the things you need to know and stuff like that. Okay, so the presentation will cover the following areas: overview of Canadian tax system, why do we pay taxes, who is required to pay taxes, income subjected to taxes, income exempted from taxes, document you need for your tax return preparation, who files your tax returns, how much tax do you owe, calculation of your tax liability, due date for filing your tax returns, and penalties for not filing or late filing. How can you reduce your tax liabilities, and topics for future discussion. So let's go to, okay, thank you. So overview of Canadian tax system. Canadian tax system is based on self-assessment principle, which means that you must complete a tax returns each year to report your income and calculate whether you owe tax or you receive a refund. It is also progressive in nature, which means that the higher you earn, the more you pay in taxes. So the next thing we look at is, why do we pay taxes? That's a very good question. The Canadian government collects taxes as a source of revenue to pay for social services and economic programs. Tax laws are set by both federal and provincial government, although tax collection is generally controlled by federal government through CRA. That means we pay taxes to both federal and provincial government. Then the next question is, who is required to file tax returns? So every Canadian resident or non-resident is required to file his or her tax return every year. Now, we say Canadian resident. So you are a Canadian resident if any of the following applies to you. Number one, if you have a family in Canada, you are a Canadian resident. If you have a property in Canada, or if you spend more than 183 days in Canada in a year, that is 6 months. If you are in Canada for 6 months in any particular year, you are regarded as a Canadian resident. Then the next one is, if you are a member of a club in Canada, so that is the law, you belong to a club in Canada, you are regarded as a Canadian resident. And the obvious ones, if you have SIN number, driver license, and the rest of them. While on the other hand, a non-resident Canadian pays only withholding tax of 25% on income he or she receives in Canada. If you are a non-resident, you have business in Canada, all you pay is 25% of whatever income you make from Canada. It should be noted, however, that you must file your tax returns for you to receive the following benefits. If you want to receive Canadian workers' benefits, which we're going to look at later, and if you want your Canadian child tax benefit, or if you want GST or HS refund, or guaranteed income supplement, you must file your tax. Yeah. Now, let us look at income subjected to taxes. The obvious one, your employment income. If you work and earn salary, everything you earn is subjected to tax. Then profit from business activities. That is, if you operate a sole proprietorship or home business, so income from there is also subjected to income tax. If you have investment income, yeah, so you pay tax on it as well. Capital gain on sales of capital properties. Then your EI benefit, if you are unemployed and government helped you with EI, So it's also regarded as income to you, and you pay tax on it. Alimony for divorcee before 2019. If you divorce before 2019, the alimony you receive is taxed, is an income to you, and you pay tax on it. Then tips and gratuities. If you work in a hotel or restaurant and you are giving tips and gratuities, you pay tax on it. Then foreign income. Yeah, for example, you are here and your partner, your spouse is in Nigeria. His income from Nigeria is subjected to tax here in Canada. Then self-employment, just like having business, sole proprietorship business, is also subjected to income tax. Then if you withdraw RSP, if you have RSP, and because things are tight and you withdraw part of it, so that part is subjected to income tax. Then your CCP benefit, you have retired and you are receiving CPP, you pay income tax on it. And all other income, except those that are categorically exempted, and we will see them. So these are the income accepted from taxes. You don't have to report the following as part of your income. GST, when you receive GST, it's given to you free of charge. You don't report it as part of your income. Child tax benefit, you don't report it, it's free. Then if you win lottery, 10 million, oh, you take it all, it's all for you. Then most gifts and inheritances, so you don't report them as part of your income. Amount received from life insurance, you have life insurance for your spouse, for your kids, and if the eventuality happens, then whatever you receive thereof, you don't report it as income. Then amount received from tax-free savings account. So whatever you receive from there is not part of your income. You have it free of tax, income tax. Then amount received as compensation for personal injuries, where you're working, you got injured, and you are paid compensation, then is not reported as part of your income. Then capital gain from sales from principal resident. If, for example, you have your first house where you are living, and for one reason or the other, you want to sell it, it's your principal resident, then whatever profit you make thereof is not subjected to tax. And then alimony payment for divorcee after 2018. The other one we look at was before 2019, then this one's after 2019. You receive alimony, you don't pay income tax on it. Next slide. Then what are the documents you need to file your tax? This is a tax season. In about 2 weeks, people will start filing their taxes. So you need to get ready. So these are the documents you need to get ready to file your tax. So all your T4s, we know all of them, T4A, T4E, T3, T5, all these, you get them ready. Then all receipt for the following. You have RSP contribution, get your receipts ready for your tax preparer, your medical expenses, your donation, tuition, adoption expenses, if you have one. Then your children's tuition, you know that your child can transfer maximum of 5,000 to you for you to claim with your returns. Then moving expenses, if you move from one province to another, whatever expenses you incur, you can claim part of them. Then union due, you belong to a professional body, you pay dues to them, then you can also claim it. Then your student loan interest. So these are part of the things you need to get ready to file your tax returns. Then the next question is, who files your taxes? Well, you can file your taxes yourself or engage the services of a professional accountant. There is no law saying you must use an accountant, but it is advisable to use a professional accountant to maximize your refunds and guide against errors. That is why we are here to help you through it. Then the next question is, when do you file your taxes? You must file your taxes and pay amount owing by April 30th. That is the deadline. If you are owing any money, it must be paid by 30th of April. Otherwise, CRA will start charging you interest. And you can start filing your taxes from February 24th. Though you can still file your taxes after the due date, but you will pay interest on any amount you are owing from April 30th until you file your taxes. That's the law. Okay. Now, there are penalties for not filing at all or for late filing. So you could be fined or criminally prosecuted for tax evasion. You could also lose some of your benefits, like child tax benefit, GST, HST benefit, and a host of others if you fail to file your taxes. Okay, so the next thing we're going to look at here is how much tax do you owe? What is your tax liabilities? Yeah, we're going to do some calculation here. I know some of us don't like arithmetics, so I've tried to make it as simple as possible. Just follow, it's straightforward, and you will understand it. So for your tax liabilities to be calculated correctly, certain things are taken into consideration, and there are 3 of them. The first one we have is what we call allowable deduction from your income. When you have your income, let's say your salary, 60,000, and then you have this allowable deduction. And so these allowable deductions, you take them away directly from your income. So I call them as, these are expenses you take out of your income. For example, if your income is 60,000 and your allowable deduction amount is 10,000, then your net income is 50,000. 60,000 minus 10,000 give you 50,000 as your net income. And among these expenses are RSP contribution, junior professional dues, UCCB repayment, child and disability support, moving expenses, interest expense on your investment, employment expenses, and others. So if you have these expenses, you just take them directly out of your income. And so this will reduce your income and favorably reduce your taxable income. Let's go to the next slide. So the second one that is taken into consideration in arriving at your taxable income is what we call other tax credits. And these are called non-refundable tax credit. So don't worry about that. It's a big term we use. So these are other allowable deductions from your income. Just like the other one we look at, deducted from your income. But this only allows 15% of those expenses to be deducted from your income. So here, you are not deducting 100%, unlike the previous one, where you deducted 100%. This case, we are only allowed 15% of these expenses to be deducted from your income. So let's look at an example. Let's say your income is 40,000 and the total amount of your other credit, non-refundable tax credit, is 10,000. So you are only allowed 1,500. That is 10,000 multiplied by 15%. That's the amount to be deducted from your net income. Hence, your final income will be 40,000 minus 1,500, which will give us 38,500. That's your net income. So among these expenses are personal amount, taxpayer and spouse. Government gives you some amount because you are working and you are married. The amount for children under 18 years. If you have kids 0 to, age 8 months to 17 years, you are giving some allowance. Then caregiver amount, you are taking care of somebody and the government say, oh, thank you. They give you some amount. Then home buyer amount. Oh, you are buying your first house. Government say, thank you. You're helping the economy. So they give you $750. Then home accessibility amount. This is the amount money you spend on helping somebody to access your home. Or let's say, for example, you have a child that is disabled and you want to make your home accessible easily for him or her. You spend some money, go and say thank you for helping him or her. We give you some amount back. Then adoption. Oh, you want to go home and adopt a child. The government say thank you for bringing additional person to Canada. So we give you some relief. Then your school fees. You go to school, they love it when you go to school. So for doing that, government say thank you. They give you some refund. Then your children's school fees transferred to you. This is something so many people don't know. Because your kids, they are in school and they don't have income to get some of the benefits given to them. But they can transfer part of their school fees to you and you can claim this benefit on their behalf. Then your medical expenses and the donation amount. So all these expenses will be put together and government will calculate just 15%. And this 15% will be taken from your gross income to arrive at your net income. Next slide. So the last one here is other credit. And these are the one I call bonus credits. So these are credits given to you 100%. This is 100% given to you if you are entitled to them. And they are added directly to your refund. That is, these ones, once you are entitled to, is given to you and you take it. No, it's not subjected to any rate or whatever. So among these ones are working income tax credit. You are a mother, you are a father, you're working hard, and you're taking care of your kids. Government says, thank you for doing this. And they give you some amount as a relief for doing that. Then GST or HST. So if you pay HST, GST on some services, the government say, okay, oh, you are not making so much money. You paying GST, HST, okay, we refund some part to you. So the amount is given to you 100%. Then there's this other one that is called climate incentive credit. Oh, we are sorry, we have polluted the climate. Oh, okay, we're sorry for doing that. We give you some amount of money as relief. Then CPP and EI. So your employer is deducting this on a monthly basis. At the end of the year, it's possible they over-deduct. And so what happens is government say, okay, we asked them to take 300, they took 400. Okay, the balance of $100, we're giving it back to you. So these are other credits that you are giving and giving to you 100%. That's why I call it bonus credit. Next slide. So after all allowances and credits have been given, A to C, then you come to your taxable income. You have your gross income, you have your 100% allowable expenses, and then you have your 15% non-refundable credit. Then you come to your taxable income. And now your taxable income is now subjected to the following tax rate at both the federal and provincial levels. So the federal government will tax you, take their own. The provincial government as well will tax you to take their own portion. And these are the rates that they use. Let's start with the federal tax rate. So the federal government says, if your income is from 0 to 48,535, we charge you only 15%. That's it. You keep the rest. Then if we earn more than that, that means from that amount, the next 48,533, the first 48,535, you pay 15%. Anything beyond that, up to the next 48,533, you pay 20.5%. Okay. Then, oh, you're making more. You go beyond that, they say, okay, the next $53,403, you pay 26.5%. Because as we said, the system is progressive. The more you earn, the more you pay. Say, okay, oh, we are even earning far, far more beyond that. Okay, the next $63,894, you pay 29%. Okay, oh, you're very close to being a millionaire. So anything you earn more than $214, $368, you pay 33%. See the way it's graduated. You're earning 0 to 48, you only pay 15%. Anything more than that, to 48,533, you pay 20.5%. Beyond that, your next 53,403, you pay 26.5. Next 63,000, you pay 29. And if you earn more than 214, you start paying 33%. So let's take a look at an example. For example, if your taxable income is $150,000, your tax payable will be calculated thus. Your tax liability, that's the column for it, then your income. Okay, yeah, your income is here $150,000. This is your tax liability column. So from above, your first 48,533 at 15%, so you pay 7,280.25. So the first amount you are paying tax on, you take it from your gross taxable. So 48,355. What you have left is 101,465. Oh, they said, okay. So from the tax rate, your next 48,533. So you bring it down there, 48,533 at what rate? 20.5. That gives you 9,949. And then that one again, you take it from the balance of 101,465. So to give you another balance of 52,932. Say, oh, you earning more? Oh, you still have some left? Okay, come on. So the next one, 53,403, but what you have left is 52,932. Say, hey, that's okay, still okay, but you still pay 26.5%. So your balance of 52,935 at 26.5% give $14,026.98. So this is the federal tax liability. And they had it together, so you are owing federal government $31,256 from your taxable income of $450,000. Let's go to the next slide. Let's see what the provincial is saying. So the provincial government will say, oh, welcome. Oh, our good child, our good daughter, our good dad. So if you are earning from 0 to 131,320, we charge you 10%. So our own, yeah, because federal government took so much, we are reducing our own. So if you're earning from 0 to 131,220, we only charge you 10%. Then you hear more than that, the next 26,243 beyond 131,220, we charge you 12%. Oh, if you have more than that, again, we charge you 13% for the next $52,487. Thereafter, when you earn more than that, we charge you 14% for the next 104,975. And thereafter, we have more than 314,928, we charge you 15%. That is for provincial government. So let's look at an example. So if your taxable income is 150,000, just like before, then it's calculated thus. This is your income, 150,000. So the provincial government says, if you earn 133,220, we charge you 10%. So 10% of that is $13,132. So you take that 131,220 from your income, you have 18,780 left. So that one falls to the next rate, which is 12%. So your balance of 18,780 times 12% give 2,253, and you have nothing left. So your tax payable to provincial government is $15,375.60. So that is where your tax liability is calculated. So it's more complex. A lot of other things go into it, but don't worry about it. Your accountant will do the job. So now let's go to the next slide. Now let us take a look at a typical tax return. How does your tax return, how does it look? This is the way it looks. But most time you don't see this because it's embedded in the software that we use. But if you go in there and you dig it out, this is what you're going to see. So we are taking an example of Mrs. Yabeji tax returns for 2017. So we have the income, which is employment income, salary. Okay, taking an example of $65,000 as your salary income for the year 2017. So you have other income. You are receiving pension, CPP, like we said, you pay tax on it. You have rental income, or you have taxable capital gain, dividend, interest you receive from your investment. RRSP income, you withdraw from your RSP. Then you have net self-employment income. If you have home business, you made a loss of 2,000 or whatever. So everything will be put together, and then it will be added to your salary income to give us 75,500. So you have your salary income, you have other income, and then you put everything together to give us your gross income. So we're bringing down the gross income from the previous page, and then deduction from your gross income. So like we said, A above, these are the deduction, 100% allowed from your gross income. The number one is RSP. You put money into your RSP, government say, thank you for doing that. We allow you to take it out from your income. You have professional due, then say, oh, thank you for being a member of professional body. Whatever you pay to them, we give it back to you. Then you have child and disability payment. You're taking care of a disabled child. Thank you for doing that. We give you. These are not the amount. These are just examples. It might be more, it might be less, depends on your situation. Then you have moving expenses. Okay, thank you, 3,500. Interest expense, thank you, 4,500. Employment expenses, like throughout last year, most people work from home. So, oh, thank you for doing that. Yeah, we give you part of the money you spent while working from home. Then UCCB repayment, okay, yeah, we overpaid you, you pay us back, okay, we allow you to take it from your income and other deductions. Let's say the total of this is 16,500. So these are the things you take off 100% from your income. So we take it from your income of 75,500. So you have net income of 58,950. Let's go to the next slide. So this one is brought down from the previous page. So we now come to the deduction of non-refundable credit. As we said, you are only allowed 15% of these expenses to be netted off from your gross income. So we have personal allowance. Taxpayer and spouse, you are giving some allowance if you are married, and then let's say it's 12,000 a month for eligible children. You have children under 18, you're giving some amount. Home buyer, giving amount for your first home. Adoption expenses, your tuition from your children, medical expenses, donation. So all these are added together to give us 31,359. But remember, you are giving only 15% to be taken from your income. So 15% of this amount is 4,704. So we take it from here, it gives us 54,246. So this is now our taxable income. Let's go to the next. So this taxable income is now subjected to federal and provincial tax calculation. For example, after the calculation, your federal tax is 6,750. And your provincial tax liability is 3,250. So your total tax payable is 10,000. You are paying federal government 6,750, provincial government 3,250, tax liability is 10,000. Now, your employer over the year deducted 12,000 from your salary as tax. Okay, so that 12,000 is there. Then now let's come to your refundable credit, the bonus credits. This one are given to you 100%. It's not taxed. So the GST, let's say it's 300, your working income tax credit 2,000, climate incentive 750, CPP overpayment 250. So total of 3,300. So this will be added to the tax deducted by your employer to give us 15,300. So total tax deducted plus credit is 15,300. And your tax liability is how much? 10,000. So that means you have 15,300 deducted from your salary, kind of, and what the government is asking for is 10,000. So therefore, you pay government 10,000 from the 15,200 you have available. So you have a balance refund of 5,300. This is how you come about your refund. The tax deducted by employer from your bonus credit, if it is more than total tax payable, you have refund. If otherwise, the total tax payable, let's say it's still 10,000, but the total tax deducted by employer is 6,000. And then all this credit is still 3,300. You add it to 6,000. That will give you 9,300. And your tax deductible plus credit is just 9,300. And you are owing 10,000. So that means you'll be owing government 300. So that is how you come about tax refund and tax owing. All right. So now the next thing we look at is what happens if you make mistakes. So you can file amended tax returns immediately you realize the error, or wait until you receive your notice of assessment. The good thing about this is that you can amend your returns back to 10 years. So within 10 years, you realize you made mistake 3 or 4 years ago, because, hey, wait a minute, I made mistake, I want to correct it. You can do this up to 10 years. So now the last thing and the final thing here is an assignment, which I want to give to you, and you go home, look at it, and then if you have questions, you have my phone number, you can call me, we can discuss it. So the assignment is that to reduce your tax liabilities, which section of the tax returns do you need to concentrate on? Look at what we did, and look at the one that gives you 100%, look at the one that gives you 15%, and determine which one you need to concentrate on. So, and lastly, these are the other topics we may look at in future, God permits. So I would like to look at RSP payment and withdrawal, how you can put money to your RSP, and when is the right time to withdraw from your RSP. Then sole business or home business, how you can use this to your advantage to reduce your tax liability. Partnership business, the same thing, how you can use it to reduce your tax liability. Then we also have tax-free savings account, how you can use it to your advantage. And lastly, Alberta government currently is giving grant to small business owners. If you have your small or medium-sized business and you've been in operation for 2 or 3 years before COVID, government will say, okay, COVID came, disrupted your business, we want to help you with some amount of money. If you are in this kind of situation, you can touch base with me. We can help you to access this grant from government of Alberta. There's also another one from federal government. That one is in form of loan. The federal government is giving loan of $40,000 and grant of $20,000, but you must qualify for it to get it. So if you have business and it's been in operation 2 or 3 years before COVID, and you have been filing your tax return using this business, you are entitled to this grant. The Alberta government grant is maximum of $20,000. So if you are in this position, touch base with me and we go from there. Thank you so much. Now the floor is open for questions.